Welcome to Oregon Cash Flow Pro. My name is James Barber, here to help you maximize your cash flow. What we're going to look at today is a specific design with Guardian. Guardian happens to be the top whole life choice among my clients due to their flexibility and the ability for us to be able to really dial in the design for what you're trying to make it do. Making a very low commitment, but being able to just dump in a ton of cash above and beyond that low commitment. The specific design that I want to do today is one that I haven't encountered too much, but it's such a unique feature that Guardian allows that it can be a really good way for people to fund their policies they may not have already thought about or been exposed to. And my goal here, as always, is to impart upon you information that you may have not come across somewhere else and or ideas that you haven't heard about somewhere else that might help you increase your cash flow, increase your finances, meet some needs, fill some gaps, solve your financial problems. That's our goal here, right? We're trying to solve financial problems. And a problem that I have encountered is somebody wants to start a whole life policy. And we know that whole life policies are really good for storing emergency funds and capital expense accounts. Basically, if you have a large amount of money that otherwise is sitting off to the sidelines, not doing much for you, you might be able to do something with it better inside of a whole life policy. So your emergency fund, if you have, let's say you make pretty good money, you've got 6 months of your salary set aside. As a responsible adult with a good financial, stable portfolio would, right? You're going to have 6 months of expenses. Well, normally we just keep that in a checking or savings account. And in a checking or savings account, we're not getting much out of it. Now, there are some opportunities these days where you might be able to get 3 or 4% in a checking or savings account. But in just a few short months ago, and for like the last decade, good luck getting more than 0.1%, less than 1% for sure. And any type of gains that you get with the checking or savings account, it's going to get taxed every year. You're going to get a 1099 interest form sent from your bank that you've got to report to the government, and you're going to pay taxes on it. So now you may get a 4% return, but after you pay your taxes, maybe that ends up net 3%, something like that. There could be a better place to store your money. And as you know here, we like our dollars to be doing multiple jobs. If your money's sitting in your checking or savings account, waiting to be deployed for emergencies, ideally, you don't encounter emergencies very often. So that money might sit there for decades and never get touched and not do much for you other than earn a piddly interest rate that you got to pay taxes on each year, the little bit of gains. If you put that money into a whole life policy, you get a death benefit. You still have access to nearly all of that cash in the first year if we do a proper design, and it's available. It's liquid. We're not giving up access to it, and you're getting growth. You can get some guaranteed growth. Even during the years, like over the last 10 years, where you couldn't really earn much in a checking or savings account, you could have been getting 4% in a whole life policy. Now that's on the guaranteed rate, even if there's no extra dividends. So even if the insurance company's not making any money, you would have a 4% guarantee. The policies these days have a 3% guarantee, most of them. They range anywhere from 2% up to 3.75, depending on the product and the carrier. But most of them are 3% guarantee right now. But the dividends have been in the 6% range, between 5 and 6% in most good whole life companies for a while now. And prior to that, they were higher than that. So there was a really good opportunity to earn better than that guarantee with that money that might otherwise just be doing one job, which is waiting for an emergency. Now, I mentioned capital expense accounts. If you're a business owner, you got a capital expense account, maybe you own rental real estate, you've got to set aside some money. Every time rent comes in, you got to set aside some money to cover repairs. Now, that money is just going to build up and be available to cover replacing a roof, replacing a water heater, replacing some flooring, whatever the case may be. But you're going to have a significant amount of money. And the larger your portfolio of real estate, the larger that capital expense account is going to be to make sure that you have enough to cover expenses. Well, where are you keeping that money? Where is your capital expense account? Most people, I would say, keep it in a checking or savings account, somewhere where it's accessible and they know they're not going to touch it because they need it to be available if something comes up. You can keep that money inside of a whole life policy and have it doing those multiple jobs. By getting that death benefit, you could potentially pay off all of those mortgages for whoever that gets passed on to, whoever the portfolio, the real estate portfolio gets passed on to. That death benefit that it bought by storing that capital expense, those capital expenses inside your whole life policy, it could pay off that whole portfolio potentially if something were to happen to you. So there's a lot of benefits to come along with that. Now, the reason I bring this up in particular, not only is it a whole life policy, a great place to store those because it's the safest growth product that we have. We know it's always going to go up at least 3% and likely more than that based on the dividends and the dividend paying history of the companies that we use. But we can start these policies with a nice chunk of change with the proper design that gives us really a very high percentage of that capital is liquid immediately. So like within 10 days of starting the policy and you funding it, that you have access to it. So you're not giving up access to it for a very long time, just a very short period of time. You're giving up access to it while they process and make sure that the funds get seasoned. Basically, it's a 10-day seasoning period, right, on new funds. And then you can borrow it out if you need to. So you can meet those emergencies. Now, with the Guardian product in particular, the reason I bring that up for this type of scenario is because let's say you've got $100,000 sitting in your emergency fund or your capital expense account, and that idea appeals to you to get it into a whole life product. But under a traditional whole life product, you're going to have a design that's 100% base premium, and it's not going to generate any cash value for the first couple of years. So if you were to move $100,000 into a whole life policy that's traditionally designed, you might put in, you might do a 10 pay, $10,000 a year for 10 years. Slowly get that money into a whole life policy. And in that first year, you put in $10,000 and you might have access to $2,000 or $3,000, maybe. In a 10 pay, you get access to a little more. You might not have any access in the first year, but maybe access to $2,000 or $3,000 in the second year. A lot of that's going to depend on how old you are and the underlying expenses along with that policy. And the older you are, the greater those expenses, okay? So that's a traditional one. That'd be if you did a 10 pay. Well, maybe you do a 20 pay and you stretch it out and you do $5,000 a year, right? Whatever the situation may be, you're not going to end up with very much cash value in that first year, and you're going to be down $10,000. So if you had $100,000, you shift $10,000 over, now you've got $92,000 that's available. $90,000 in your savings account still, $2,000 or $3,000 in your whole life policy. It's not too bad. And slowly over the course of those 10 years, you get that $100,000 in. But that type of a policy does not break even in 10 years. Now, 10 pay, it's going to be close to breaking even in those 10 years. Okay, but you're still not quite going to have more cash value than you had in your emergency fund. And what happens if during that time you encounter an emergency and you need to tap into it? You might not have the funds to be able to continue moving them into that account. It could just cause some complications. Okay, so the alternative, the other designs that we have, we could do a 90-10 design, which is often what we advocate for. If we have a chunk of money to move in and we want to have it be a very efficient design. In fact, this typically the most efficient design is a 90-10 type of policy. We put that 100,000 in, and we end up with about 83,000 in cash value. I think that's 82, between 80 and 82 these days in cash value. Now, prior to the 7702 changes a couple of years ago, we would have over 90% cash value. Now, there is some products, high early cash value products, that you can squeeze that up and get closer to 90% still these days, but they're a little less efficient products. And even with Guardian, they offer a certain type of paid up additions rider that can reduce the expenses, and you can get up around 87%. But that's going to hurt your longer term growth in that policy to have that type of design. So oftentimes we'll just go with the 90-10 design that gives us about 80% cash value that first year. Those policies tend to break even in 6 or 7 years. Okay, so we would design that to absorb that $100,000 over the course of 5 or 6 or 7 years, and you're going to hit your break even in 6 years, and it'll be a really nice, well-performing policy. Cash value in year one, let's say you put over 7 years, so we're going to be at like 12,000. No, 7 and 15, just under 15,000 a year. So let's say 15,000 a year. That'll get you all 100,000 in 6 years, just over 6 years, right? You'll have a little bit more to put in year 7. But in that first year, you got 15,000 you put in, and your cash value is going to be probably figure 80% of that. So we're going to be about 12,000 in cash value. I think those numbers add up right. So about 12,000 in cash value in that first year. You had 100,000, 15 went in, you got 12,000 cash. That's 97,000 that you still have access to, approximately. Might be slightly less than that. But now you've started your policy. And we know that in 6 years, you're going to have more than that 100,000 that you started with by getting it into the policy. You get the death benefit along with that, as well as the growth that's going to happen beyond that. So it's a really good way to handle getting that money in. Really nice and efficient. You still have most of that money in a savings account, though, in that first year, right? Most of it's in that savings account because we can only put in 15,000 a year. The design we're going to do today is going to boost that first year's payment by 50 times. So the base premium, instead of a 90-10 design, we still do a 90-10 design, but that first year, that in a 90-10 design, the 10 being the base premium. The base premium is what doesn't really turn into cash value in the first couple of years in a whole life policy. So we still do a 90-10 design, but that base, instead of being very high, or in this case, we could still have the base be in the 90-10 design with putting in 15,000, our base would be 1,500, right? It would be 1,500, and we could put in 15,000. We can put in 10 times that base premium. But the design that we can do with Guardian, we can do 50 times that base premium in that first year. Meaning in that first year, we could put 75,000 in with that exact same 90-10 design by adding in a renewable term rider. So it's called the RTR rider. When we add that, we're going to increase the death benefit a little bit for those 7 years. But it's going to be a nice low-cost term policy that we blend in with this. And it's going to increase that MEC limit to 75,000. So we could get 75,000 in that first year with still having a base premium of $1,500. So that's what we're going to look at. We're going to take a look at these different types of designs. Okay. Is all of that making sense? I hope it is. So with Guardian, we do a level Q term blend. I'm going to start designing this right now, and I'm going to share my screen with you when it's done. It'll only take me a few minutes to get these numbers in. I'm going to do this for a 35-year-old male that shares the same name as me, because I just put my name in for this. This is a generic illustration. In this scenario, we're just moving in this emergency fund, and we're not going to put any more money into this policy. That's it. So we're going to do a reduced paid up after that. Reduced paid up beginning in year 8. That way we don't have to contribute any more money. And so we can really get a good idea of what our cash is going to do inside of this policy, as opposed to just keeping it inside of a checking or savings account. Okay, this is good. So $383,000 is our death benefit. It allows us to get just over $100,000 in over the course of 7 years. Here we go. So we've got the L95 here. This is your normal 90-10 design. Okay. Here's the base death benefit. This is the additional target. This is annual renewable term. The reason we do these types of designs, it's heavily funding PUAs, which essentially turn into cash value, but it also reduces the commission by a lot. Okay. Your commission is generally based on a base premium. So if the base premium on this, if you were to put in 15,000 and we had 15,000 a year as the base premium, the commission would be based off of that 15,000. So it might pay 7,500 in commissions or somewhere around there. Okay. Depends on the carrier, depends on the contract you have, but agents generally make like 50% of base premium as that first year's commission. After that, it reduces for the next 5 or 10 years. I don't pay too much attention to what the commissions are that pay out. I just know the designs that pay less. But each carrier has different commission rates and such. So I try not to keep up on that. I would rather focus on learning these products. So here's what we're looking at. Let's see, do I need to make this a little bit smaller? Let's go a little bit smaller. Let's get to the supplemental illustration. Here we go. This is our values. So 15,000 going in. Oh, look at that. That was a pretty good guess. I said about 12,000 in cash value. We got 12,080. I had no idea that number was going to come up there. I was just guessing based on my knowledge, playing around with these illustrations, that's around where it would have been. That's just over 80% cash value in year one. Okay. Where's our break even? Not quite in year 5. Looks like it's here in year 6. You can see we put in a total of 90,000. Here's where I'm looking, 90,000, and our cash value just over 90,000. So our break even is in year 6, and you can see we put in a total of 100,447, and we're not going to put any more money in after that. Well, what happens? We're going to do the reduced paid up. The death benefit drops in year 8 when we do the reduced paid up, and from there it's going to climb again. So you can see that happening right here. It's going to start to climb again. Oh, it's not sharing it on screen when I highlight that. That's interesting. Okay, so you can see my mouse though. So our death benefit goes up. This next column right next to it is our cash value. So we pass the break even, and from there we always have more cash value than we've paid into it. Now this cash value works just like a line of credit. So when you need to access it in an emergency, to access those funds or your capital expense account, you're going to borrow against these dollars. You're going to pay 5%, and you're going to get an offsetting credit from the insurance company on those dollars you borrowed. That's going to also be 5%. So we're essentially borrowing our money out of here, even though we're borrowing against this. We're collateralizing this with the insurance company, but we're not going to interrupt the growth and the compounding that's going to happen inside here. Okay, at least not a whole lot. We're not going to get the dividend rate because Guardian is a direct recognition company, but we're going to get an offsetting credit based on what the cost to borrow is. That's nice because we always know what the cost to borrow is. In this case, it's fixed at 5% for the life of the policy. So you borrow from it when you need to use it, and when you pay it back, it's available for you to borrow again. And in the meantime, it just keeps growing and keeps growing. So you can see here, for this 35-year-old male, by the time they get to age 60, you got 256,000 in here. They put a total of 100,000. This emergency fund more than doubled during that time. If it was just kept in a checking or savings account, that's not going to happen, right? And in the meantime, he also had this death benefit. So if something happened to him early on, the death benefit pays out. Okay. And this is hundreds of thousands of dollars more than the amount of cash value that's in the policy. So it's a nice little payout. That's our dollars doing multiple jobs. And the access to this as a line of credit is guaranteed per the contract. So these work really good for this purpose. Now, I'm going to pull this back and I'm going to do the 50 times design, and we're going to see how that compares. We have quite a bit more death benefit. You can see over here, we have a total death benefit of 2.4 million. Actually, it looks like it's right at 2.4 million. So 2.4 million death benefit. We had to increase the base premium. This is a 1960. We've got the target additional, which is a part of that premium. Well, it'll list the charge separately, but then we have our renewable term rider. So this extra 2 million is $540. That's the cost of that renewable term rider to get 2 million for the next 7 years. Okay, 540 bucks. This is how our cash goes in. We've got our scheduled premium and unscheduled. Unscheduled, you can throw that in whenever you want to. But this is assuming you put it in within the first 60 days. Okay. Total first year premium, 100,000. We're going to get all 100,000 of your emergency fund in there in the first year. Now, what does that do for our cash? And how does this compare to a normal 90-10 design? Here we go. 100,000 going in, cash value, 90,000 in the first year. So compared to the one we had before, where we're putting in 15,000 and we had 12,000 in cash value, you still have 85,000 in your savings account. So you're going to have access to more money in this scenario. You got 97,000 in total dollars that you still have access to if you just do the basic 90-10 design. But remember, our break even happens in year 6. And by the time we get to year 7, we put all of the emergency fund in. We're at $104,000 in total. When we go to the one pay design, by the time we get to year 7, we've got an extra $5,000. And our break even was almost in year 4. Our break even actually happens in year 5. And this is with only funding it that 100,000. Now, what happens between years 2 and 7 when we haven't added any funds? This is what's called a premium offset. The base premium still has to get paid because that doesn't go away until after we do the reduced paid up here in year 8. So this is actually coming out of the growth. The growth is going to make these payments. Okay. So in this scenario, we just put in 100,000 and we let the policy pay for itself through year 7 until we could turn off those premiums. So this is not as efficient as it could be if you were to keep adding a little more money, because you can keep putting in money in all of these 7 years. And this policy is actually going to be even more efficient than it otherwise was. But we do have more cash value. We put 100,000 in, we got more cash value in year 7 than we did in that first design, which was a 90-10, which wasn't bad by any means. Now, where are we at down the road? How about 30 years down the road? Let's see where we're at. 30 years down the road, age 64. This one's at 309,000. This one, age 64, we're at 323. We got an extra $14,000 now in this policy. We were able to get more money in sooner. We had a much bigger death benefit. So if an accident happened, you died during this time, your beneficiaries are going to get a lot more money paid out. Okay. Now, we chose to get rid of it here, right? That doesn't have to be part of your plan, but this is how we optimize for cash growth, is by making sure that we get rid of that as soon as we can. Okay. So sometimes people will go with a design like this in order to get that money in, have it working, and ultimately end up with higher cash values down the road. This is a very, very efficient design. Our cash percentage value in that first year, 90%. With the other 90-10 design, we were right at 80%, just over 80%. Okay, we put in a lot less money. And so when you add in the savings account in this one, you still have access to more of it in the 90-10 design. But getting it all into here, if you don't anticipate needing access to all of that or more than 90,000, this is a better, more efficient design long term. Now, in both scenarios, you could keep funding it longer than 7 years if you want to. In the first scenario, in this one, we're already max funding it right here in these early years. So you can't add more money in. But in this scenario, you can add more money in during these years. You don't have to do the premium offset. So there's more flexibility with this design that after the first year, if you're happy with this product and you're like, can I keep throwing more money into it? Because I want to. I know what it's going to be doing. It's actually doing very well for us. Yes, you can. You just wouldn't do the premium offset. Let's take a look at the internal rate of return. So here's our internal rate of return. At 30 years, we're at almost 4% internal rate of return on that cash value. What the internal rate of return means is that is the average rate of return every year in the policy. So when you look early on, we have a negative rate of return. That's because there's expenses and we haven't hit our break even. Once we pass our break even, we have a positive internal rate of return. Okay. This is the equivalent, the cash value is the equivalent of if we earned 0.57% in the first year, and then again in the second year, and in the third year, and in the fourth year. That's what that number represents. When we come down here to 3.99 here in year 30, that's as if we got 3.99 this year, this year, this year, this year, every year prior to that. So this internal rate of return is not a reflection of just that year. That's every year prior. That's why we see it continue to go up, because we started out slightly negative, but we've been earning, in this case, it's assuming 5.75% dividend every year. Okay. That's Guardian's current dividend rate. And you can see down here in your 80s, we're up to 4.2. That is a really good long-term performance in a very safe product, and much better than if you ride the roller coaster and pay the taxes on keeping it in a checking or savings account. The rates on those are going to go up and down. You get no guarantees. In this, you get guarantees. You have the death benefit, and we have really good long-term performance. Now, if dividend rates go back up again, these numbers can even be higher. We do expect dividend rates to start climbing again, but there's no guarantees. There's no guarantees on that. What does this do on a guaranteed basis? This is one of the benefits and one of the appealing things to whole life, and why you would do something like this in whole life. And we're not going to be able to see here because it doesn't show all the extra paid up money going in on this guaranteed. I wonder if it shows it in a different report. It does. Okay, so here's our guarantee where it counts the 100,000 going in. But this one also assumes you're putting cash in. This has annual premium going in. Yeah, this is not making the proper assumptions in here, unfortunately. But this is what it would look like on a guaranteed basis. Okay, if you did have to keep putting money in, this is not very attractive because of that huge term cost. When you see a guaranteed, it's going to assume that it's going to charge you a lot more for that term insurance that's blended in with it, and no dividends ever. So it's just going to get the bare minimum credits, but the cost in this policy is going to be quite a bit higher. If we look at the guaranteed here on this one, the guaranteed is a lot more attractive. Here by year 7, we've got 94,000 in cash value, and we still only put in that 100,000. So that's really good compared to this one, where by year 7 we have 113, but we put in 100 plus 8, 18, 28. We put in 128,000. right? It's still okay, I guess, but obviously not an ideal scenario. So in your basic 90-10 design, though, the guaranteed scenario plays out pretty well. And you still end up with a break even on a guaranteed basis that's going to happen fairly early on in the policy, probably like around year 12, maybe year 10 or 11. We got 100,000 that's gone in by this time. This is 102, 104, 106, 108. Yeah. So basically by year 11, you still break even on your 90-10 design. So for people that really want the safety, this could be the better choice. The normal 90-10 design, absolutely nothing wrong with it. But if you want to get that cash value in, and we do expect dividends to stay up, Guardian's been paying above the guaranteed rate for 150 plus years. So I think there's an established track record that would lead us to believe that that would continue to perform on into the future. Now, here's what it looks like if you just put a little bit more money in each year. You can see this break even. Well, our cash value by year 7, instead of being 113, we're at 130, right? And we put in an extra 12, 13, 14, 16,000. So you can continue to keep funding it. I think this is just the base plus the cost of the term insurance. That's what this is a reflection of. So you can definitely keep throwing money in. Based on the base premium on this, you could continue to throw in 20,000 a year if you wanted to with this type of a design. So pretty cool. A lot of neat things that we can do with this. And if you're interested in seeing what we can do for your situation, come and talk to us. Again, the link scrolling along the bottom is the link to set up a meeting with me. We do a Zoom meeting. I share my screen. You get to see this. You get to see me design the illustration. You can ask questions. We can play around with the numbers in real time like I did during this live stream. And it's a really great way to design your policy, but also help you to understand what's happening inside of it. So I appreciate you joining me today. We're going to wrap it up with that, and drop your questions in the comment section. If you have any questions, we will do our best to address it. We're going to come back next Thursday. So Tuesdays, remember, we do live stream IUL illustrations. Thursdays, we do whole life. If you have any questions, anything you want to see, if you have any recommendations on what you might want me to illustrate in the coming weeks, if you have a policy you would like me to review live, you can send that in to my email. I'll redact the personal information so we can share it, just like you've seen on my prior live streams. And if you want to just have me do a policy review one-on-one, not sharing it on my YouTube, just sign up for a meeting with me again at that link below with my Calendly link. So thank you for joining us. We'll be back again next week. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.